Oh, there it is. Okay. Well, good morning. Yeah. My name is Jason Cave, and I'd like to extend a warm welcome to all of you joining us for the Federal Housing Finance Agency's first ever TechSprint. Speaking of warm, we scheduled this event in July on purpose. If you are willing and able to survive summer in DC, then you might just have what it takes to discover new ways to secure the free and fair flow of data in the mortgage process. So welcome to Velocity. We have an incredible lineup of esteemed speakers this morning, starting with FHFA's director, Sandra Thompson, followed by John Hope Bryant, who is the CEO and chairman of Operation Hope. And then we will hear from a diverse panel on the growing role of data science in housing finance. Introducing the Honorable Sandra L. Thompson to kick off this week's event is a distinct honor and privilege for me. I count myself as very fortunate to have worked with the director for over 20 years at both the FDIC, where she led the Division of Supervision and its 3,000-strong examination force through the global financial crisis, working alongside bankers, examiners, and the public through arguably the most challenging period in the FDIC's 90-year history, and at the FHFA, where she has tirelessly worked to ensure that the enterprises and FHLB banks fulfill their mission by operating in a safe and sound manner to serve as a reliable source of liquidity and funding for housing finance and community investment. And it will come as no surprise to anyone who knows her that Director Thompson provided the vision and thought leadership to make this week's event a possibility. Director Thompson understands that one of the key factors in making the mortgage process equitable and sustainable, as well as safe and sound, is to make the process as cost-efficient as we can. And technology provides us all with an opportunity to achieve progress. One of the reasons for establishing the Office of Financial Technology last July, which seems like 5 years ago, was for the agency to become smarter about where technology can be applied to eliminate bottlenecks and bring the process into the 21st century in a safe and secure manner. Today, we have 80 sprinters ready to meet that challenge. We want to spur innovation and build a community of individuals who are passionate, curious, open-minded, and committed to improving the mortgage experience. And as Director Thompson always says about efficiency and safety, that's an and, not an or. So remember that when you come up with your winning ideas. As a reminder, this event is being recorded. And with that, Director Thompson to kick off this week's event.
See? Very good. The flag will not fall on my watch. Thank you so much, Jason. I really do want to begin by thanking all of you for joining FHFA for our inaugural TechSprint. We could not do this without you. When we launched FHFA's Office of Financial Technology last year, I said that fintech, when responsibly used, has the power to really improve the borrower's experience within the mortgage industry by reducing barriers, increasing efficiencies, and lowering costs. That point has only been reinforced over the past year by the feedback FHFA has received through our requests for information, as well as the numerous meetings that Jason and his team have held. Housing finance is often reliant on paper-driven processes in today's digital world. And it's really hard to make progress on long-standing challenges when we continue to do things the same way we've always done them. That's why FHFA is hosting this TechSprint, to do something new to foster responsible innovation in the housing finance market. The lessons we learn over the next few years will move us towards a housing finance system that's accessible, affordable, and sustainable. I'm really looking forward to hearing the new ideas that you all develop over the course of this TechSprint. And I hope that the mortgage system can follow your lead as it catches up to other sectors that have used new technologies to create business efficiencies and improve customer experiences. Lasting progress can only be achieved when new ideas successfully obtain widespread adoption. Having the technology is nice, but using it and adopting it is even better. Digital mortgage products have been on the market in some form for at least 20 years, and the enterprises do offer automated tools. But we all want to see concrete solutions that deliver better results. That's why this week's TechSprint centers around the question of how data digitization can help drive transparency and increase access, fairness, affordability, and sustainability in mortgage lending. And it's why I'm particularly pleased to introduce today's keynote speaker, John Hope Bryant, who is joining us remotely. He's the chairman and chief executive officer of Bryant Group's Ventures and the Promise Homes Company, which is the largest for-profit minority-controlled owner of institutional quality single-family residential rental homes in the country. He's worked tirelessly to equip people in underserved communities with the financial tools and training that's needed to take ownership of their lives and create a secure financial future. As a lifelong entrepreneur who started dozens of entities and companies, he's intimately familiar with the concrete realities of startup life and fostering practical innovation. And he's also the founder, chairman, and chief executive officer of Operation Hope Incorporated, the nation's largest nonprofit provider of financial literacy, financial inclusion, and economic empowerment tools and services. Please join me in welcoming an American entrepreneur, thought leader, and philanthropic visionary, Mr. John Hope Bryant. John, thank you.
Honored to be with you today. Sorry I can't be there in person, but COVID did deliver some good things. Rainbows only follow storms. You cannot have a rainbow without a storm first. It's not just philosophy. Good philosophy is a scientific fact. It introduced for the first time this video conferencing and video talking, and in some ways modernized how we all interact with each other. Now, technology is more efficient, it's not more effective, so you need high tech and high touch. I'll get into that in a minute. Before I say anything else, let me just say, you've got one of the most incredible directors on the planet. Sandra Thompson, as we say where I grew up in my neighborhood, excuse me for the informality, but the only way I can really describe this is she's a bad sister. That's SISTA hyphen. She doesn't walk on water, but she knows where the stones are. She's really quite incredible. And she's completely committed to public service, has given her whole life to it, and deserves incredible appreciation that she won't get. But those in the know are fully aware of her gifts, and you're seeing some of that authenticity come through even in her opening remarks. I want to commend my friends who I know are there speaking today. And Ms. Barefoot, who is fantastic, Faith Schwartz. I know that you got Chase in the room. You've got the founder of Isuzu, who is amazing. Africa in the house because of him. He is fantastic. Melissa Koide, Pete Carroll, Aspen Institute is there. Amias Garrity, if you get a chance, ask Amias what piece of history he helped to create with me. The now Deputy Secretary of the Treasury, who's another incredible human being. We together renamed, the only individuals ever to trigger the renaming of a building on the White House campus. the Treasury Annex building to the Freedmen's Bank building. He can tell you that story. He's a really cool guy and a great human being. This is going to be a bit of an interesting presentation for you, from me, because I'm not just here to talk about the technical aspects of the mortgage space, the mortgage industry. I'm not going to suggest to you that there's a more efficient way of doing this. You know all of that. I'm here to say something else. That you're sitting in a moment in history right now. But history does not feel historic when you're sitting in it. It just feels like another day. But that does not mean that the moment is not, in fact, historic. It takes 20 years to look back at a moment and see it in its historical context. Children and grandchildren will ask you, what did you do in this moment? Everything matters, if you haven't noticed. Everything matters. What we do in what I call this third Reconstruction period, and you are right in the middle of it, and I'll explain what I mean and unpack that in some detail in just a second. But what we do in this third Reconstruction period, and I mean third Reconstruction because first Reconstruction happened right after the Civil War. Abraham Lincoln and one of my heroes, Frederick Douglass, I love both of those human beings, couldn't be more different, but found that they were better together. And pivoted into what I call the first Reconstruction, which was freedom. And there were some advancements. There was this Reconstruction period, and fortunately, folks without vision caused that period to falter. And Lincoln was assassinated a month after saying something bold, that all Blacks should have the right to vote. So you had 40 acres and a mule, February 1865. You may not know that story. It's Field Action 15. 40 acres. There were no mortgages back then, obviously. The government allocated 40 acres for former slaves. And then they worked that land. Those who got the land, it was not good land. It was not agriculturally good land. It was on the beach. It's great land today. It was on the beach from North Carolina down through Florida. And they worked that land so well. They said, my God, they're so industrious. Give them a mule. That's like saying invest a tractor on some farm today. So it wasn't a handout, it was a hand up. It wasn't charity. That was technology of that day. And that was January 1865. In March of 1865, Abraham Lincoln signed legislation for a bank called the Freedmen's Bank, chartered to teach free slaves about money, called that financial literacy, circa 1865. And then, unfortunately for him, fortunately for the boldness of leadership, did say, and I'm going to give every Black the right to vote. He was trying to create the economic rehabilitation experience for this group of people who had worked their entire lives for free. Their lives, their parents' lives, their grandparents' lives, 270 years of free labor. And he was assassinated in April. And Abraham Lincoln thought this was so important to him that he put it across from the White House, this experiment, and right down the street from where you are now. And Frederick Douglass, who you know to be an abolitionist, I know to be a businessman, also who owned $6 million worth of real estate in Baltimore, Maryland, and rented it out to working class Blacks. Hello, you should do some research on him. He had financial freedom. All money is freedom. He had financial freedom to be able to go pursue social justice because he owned this real estate. And he went to go run this bank, put $10,000 of his own money in a bank that would have $1.3 billion of assets today. Unfortunately, Reconstruction ended prematurely with the assassination of Lincoln. You fast forward now 100 years, you have the second Reconstruction, which was after a difficult period in the South. civil rights movement right here in Atlanta, the moral capital of America. My mentor and friend, Ambassador Andrew Young, worked with his friend, Dr. King, and others to launch a movement about access. And access for all, because as Dr. King realized and said back then, there are more poor whites in America than poor anybody else. The largest population then and now of poverty in this country are poor whites. And so it wasn't about black or white. It was whether you're white or black, red, brown, or yellow, you wanted some more green, as in U.S. currency. And that was an opportunity for access, and it was the Poor People's Campaign. And Dr. King was assassinated in April of 1968, the same month as Abraham Lincoln was assassinated about 100 years earlier. It's interesting that Financial Literacy Month is also April. You fast forward to the murder of George Floyd, and you have the third Reconstruction, which is about opportunity for all. And this is where you come in. And that's 2020 to 2030. And before you begin to think too much that I'm talking about Black people here exclusively, let's see if this resonates with you. You have the largest economy on the planet, the United States of America, by far, largest economy. Anybody who tells you that China is whipping our rear end is lying to you. The data, I love math because it doesn't have an opinion. And the math is clear that we are the economic leader of the world. And I don't believe that China can win a fair fight against us, which means, and I want China to be successful, but they can't win a fair fight because they don't have our special sauce. And the only one who can screw up our magic moment is us, which I'll get to in a second. So let's see if this resonates with you. Largest economy in the world, everybody agrees on that. 70% of this economy led by consumer spending. Maybe you know that. Most people in the room are pretty thoughtful about finance and where the economy is. So my guess is you know that. What you may not know is that 70% of all Americans are living from paycheck to paycheck, and half of anybody making $100,000 a year is living from paycheck to paycheck, and a third of those making $250,000 a year are living from paycheck to paycheck. We're all in this mess together. Irrespective of that, you make money during the day, you build wealth in your sleep. And I'm gonna talk about my story in a moment because I think it is emblematic of what you can do to help transform our economy for the next 100 years, what you do in the next 10 years, 2020 and 2030, the third Reconstruction period, which is a movement in the suites, not the streets. It's a movement about class, poverty, economics, opportunity for all, not race and the color line exclusively. Yes, race is an issue. It's not the only issue. If race was the only issue, you would not have more poor whites than poor anybody else. If race was the only issue, you would not have Black Africans with a different experience and Black Caribbeans with a different experience than Black African Americans. They're all Black. So race is an issue. When mainstream America has a headache, Black and brown folks have pneumonia. We're all sick, but it is not the only issue. This exposure, this opportunity, these ecosystems that some live in and some don't. If you hang around 9 broke people, you'll be the 10th. Matters. And again, you're right in the midst of this opportunity for all movement that I see happening right while we sit here today. And what you do now will last for your generation and the next. And part of the reason why I think we're fraying on our values and fraying on our beliefs and fraying on our spirituality and acting like some of us in an inhumane way and losing our compass of what public service is, all kind of crazy stuff going on right now, is because we're 2 generations from Dr. King or any other leader of moral authority. And we can't just have one Dr. King. We need to have hundreds and thousands. There were literally thousands of organizations that were backing the civil rights movement. It's just that Dr. King was a spokesman. And we need spokesmen and spokeswomen today who are in this fight because you died twice. You died physically and you died secondly when the last time someone mentions your name. You want somebody to mention your name, and they're not gonna do it based on what you get, it's about what you give. It's what you do for others. So I've said something pretty bold and audacious, that we're sitting in this moment in history, and that you have a history-making part. But I haven't mentioned mortgage or technology once in that setup. I did say that you make money during your day and you build wealth in your sleep. Okay. What was the biggest first boom for the working class to be able to generate some wealth? You had this 4 years in the mule experience, which didn't work, and the president after Lincoln canceled it. You may not know that. Let's fast forward now to the Western expansion, and you had this Homestead Act that domiciled majority of land in this property for individual ownership happened as a result of that Homestead Act. Then you had, which was mostly not diverse in its allocation, but that's a setup, not the fact. But then you had the FHA in the early 20th century that guaranteed or triggered the guarantee of mortgages. And you had banks who financed. And really, it was the FHA, it was the government. This is why I love that this is full circle now. People like Sandra Thompson in place. It was the government actually that inspired redlining because they would not support, insure, guarantee in certain neighborhoods, read black, read brown. And the neighborhoods that they did trigger that support in, that's where the mortgages went. That's where the value took off. So in other words, you cannot have growth in America without banking and financial services. And back in that day, that period's version of technology. And let's now fast forward from that period. That was a big boom. And that's really where redlining again started. You go now to right after World War II, the GI Bill. And the GI Bill, and again, more than 99% of all of those mortgages for the GI Bill went to non-Blacks. You can figure out what I'm talking about, but to be direct about it, that's where the white middle class came from. And I think it's fantastic, by the way. This country would not be what it is without a middle class. You need a middle class. It's just that the middle class in the future has to look different. There are not enough college-educated white men to grow the economy for 40 years. You need women. You need people of color. You need folks to be able to come up from nothing and to support growth in this country and specifically GDP. We are better together. Can I get an amen? I'm not sure if I can hear you, but maybe you should say that to your partner next sitting to the left or the right. If you didn't go to church yesterday, you will go to church today. You just tap somebody on the shoulder and say amen. And when you look at progress in this country, it was because we were incredibly educated after the Civil War, and everybody had a chance to put their buckets down and get a stake in the system. My story. My mom and dad came from the South, deep South. We don't have time for the details, but my grandfather was born into sharecropping, born in 1871 in Mississippi. My great-grandfather, my father's side, and my mother's side were slaves and mother, which is deep to think about. And my mom and dad, with a high school education, came to South Central LA. They had me, they owned a home. The mortgages came from Bank of America and Wells Fargo. By the way, for these homes I'm about to talk about, they owned a home. They owned a cement contracting business. They owned a gas station that was a commercial loan on that property. This is in South Central LA. We owned an 8-unit apartment building we bought for $18,000. Today it's worth millions of dollars. Don't celebrate, we lost it. But my family built wealth. We made it, but couldn't keep it. My dad confused making money with building wealth. I told you, build wealth in your sleep. He was not financially literate. No one stopped to teach him the rules of the game. And so, make a long story short, mom and dad fought over money. We lost it all. My dad didn't realize that they were better together. Did not ask my mother for support and help. I just saw my mom, who's 89, last night, and working an hourly job. So let's now go back. Think about what I'm about to say to you now. Think about what I said to you about what happened after the first Reconstruction. Think about in the lost opportunity there, not just for Blacks, but for America. Think about what happened in the second Reconstruction. Think about the period that happened with the GI Bill and who was left out. And think about when I tell the story, the lost GDP and lost opportunity, lost jobs, because it's a knock-on effect. You get a mortgage and you start hiring gardeners and painters and fix-up people and all kind of title company, all kind of folks in that food chain. Economics just ripple. You know what I'm talking about. And think about what would happen if we had included more of God's children in that conversation, in that transaction, in that reality. As I explained to you that with an hourly job, my mother has an I think her credit score now is 865. I didn't even know it went that high. My mother's not black, she's green. I asked my mother, would she get married again? She said, yeah, baby, maybe I might get married. If I'm married, he's gonna be a BMW. I said, Mom, don't be so vain. Don't be so shallow. That's not a car. I'm talking about a man. She said, I know you're talking about a man, baby. If I get married, it should be a BMW, a black man working. My mother's real focused. Well, Mom and Dad divorced over money because my mother wanted to send my brother to college, so school of his choice, and had saved $4,000. She knew that education was the way out. There's nobody in my family who had gone to college at that point from both sides of the family. And my dad got to the bank first, and my mom said, that's it. She left, and we had to start over. And my brother, by the way, who I'll see later today, is in the Navy, retired from the Navy, works as a contractor for the Navy in Hawaii, married Hawaiian. Why? Because he went to get his education through the military. And that's where he also got his mortgage, by the way, the credit union there. And his whole life was formed by that $4,000 miseducation, misdirection by my dad, who meant well but didn't do well. Good intentions are not enough. You got to be PhD and PhD too. What you do in the suites has to reach the streets. You've got to see your agents for change. All of you are playing a role in history. And Mom and Dad divorced over money, went their separate ways. We lost everything. So that generational wealth, poof, 41, 42, 43% of Blacks today own a home in America, compared to 72, 73, 74, 5% of our mainstream counterparts, a delta of 30%. That 30% is your opportunity. That's African-American numbers. You also know that there's a gap in the Latino community. It's a gap in these other major ethnic groups. But this is a huge, and I think it's the largest gap, and it's the largest untapped opportunity in this country. Is sustained home ownership for the least of these God's children. Not a handout, a hand up. And my mother went to go live with a girlfriend to save money for a down payment for her first home. The guy who was the boyfriend of the girlfriend, I was told was my uncle, so I wouldn't get nervous that we were staying with him. He saved my life because I fell on the porch and was swallowing my tongue, waiting for him to get home, and he was murdered in front of me. Again, if you're interested in that story, you can read my book Up From Nothing, but I'm just trying to give you a texture that even though life was not easy, we rose. And my mother saved enough money, bought a home, 15502 South Fraley Avenue in Compton, California, and working at McDonnell Douglas Aircraft, an hourly job, and did so well with that home, she bought 7 more on an hourly job. And because she had a banker who understood her, an employer who she could count on, and financial literacy that allowed her to understand how to build wealth, even though she was just an hourly wage worker. And she's financially independent to this day. Now, my mother bought 7 homes. Her mother owned 1. The mother for that was a slave. I own 700. So slave holding, a shotgun shack in the East St. Louis, 7 homes. I own 700 through the Promise Homes Company. That's not genius. That's role modeling. There's nothing smart about me other than I paid attention, and I'm building on the foundation that came before me. Today, I'm the largest minority owner of single-family rental homes in America, and we're giving financial literacy to all of our residents at the Promise Homes Company. For free. If you pay your rent on time, we reward you. If you raise your credit score 100 points to 700 from where you come in on an entry point, and we use the SUSU, by the way, for rent data. But if you raise your credit score, we'll lower your rent by 10% as long as you keep your credit score above 700 as an incentive. And it's not a handout because we believe that person's creating less noise on our balance sheet. We're not chasing them for rent. It's less effort from us no need well, we should pass on those savings, and that's what we do. Is more accretive to us. We're also looked at our balance sheet and our income statement, well, our balance sheet in particular, and said, we have all these homes, we're doing all this maintenance. Why shouldn't we not prioritize communities that have invested in us? So now 50% of all of our maintenance, plumbing, heating, electrical, landscaping, roofing, all the other maintenance jobs, they can go for somebody with a high school education and a trade, those should be minority and women-owned contractors. So 50% plus of all our contractors are minority and women at the Promise Homes Company. That would not happen if I was not the owner. So ownership matters. Nobody washes rental cars. I'm giving it to you fast and quick. Hopefully you're writing this down. Some of this is actually funny. It's funny, but it's also true. And then we give folks a chance to go from rent to own. So affordable housing to affordable care. I hope that was a positive thing. Somebody screamed. I said you were going to church. So that experience came from my childhood. That company was inspired by my childhood experience. And at the same time, I lived with my mom in South Central LA. I had witnessed by that time 2 murders in front of me by the time I was 9 years old. And these were smart people with a bad business plan. And so we didn't understand money. No one stopped to teach us the language of money. So when I went to school and this banker came in my classroom and taught me financial literacy, you happen to be from Bank of America, blue suit, white shirt, red tie. I asked him by the third session, I wore a suit that was just like his. Well, it wasn't like his. It was the only suit I owned. It was a crushed velvet 3-piece suit with a big bow tie and a ruffled shirt, which I'm told is rumored going to be in the Milken Center soon as one of their exhibits. And a little briefcase that I carried that I had mail order catalog forms in it that I would sell mail order whatever to my teachers. But that all came because I saw this banker come in my classroom with a suit, and I wanted to be like him. He just happened to be Caucasian, and but he was green as far as I was concerned, because he was teaching me something that I didn't know that changed my life. And I asked this guy this: what do you do for a living, and how'd you get rich legally? And I was dead serious. And he said, I'm a banker and I finance entrepreneurs. I said, sir, I don't know what an entrepreneur is, but if you're financing them and it's legal, I'm going to be one. And how many bankers are there in America? He told me at that time it was millions. And how many banks are there in America? He told me at that time it was 10,000 banks, it's about 4,500 today. And I said, wait a minute, it's your job? It's your job to give me access to capital, people like me, as long as I can qualify? Yes. So today's work at Operation Hope, which is the largest nonprofit financial inclusion, financial coaching organization for the underserved in America. We are America's financial coach, 250 locations, on our way to 1,000. We just launched the 1865 project, which will finish the work of Frederick Douglass and Abraham Lincoln and the Freedmen's Bank. Just launched that. You can look that up a little later. We're quarter to our goal. We have 250 locations. We're the Starbucks of financial inclusion, the Walmart of financial literacy. We are moving, and this is now pivoting now to your work, because there's a reason that there's a gap in mortgage, in mortgage approvals, which will then leads to home ownership. And this is part of why the magic I want you to work on with velocity as you sprint with TechSprint, because what you do now really matters as we try to figure out ways to include more people sustainably in this economy, inclusive capitalism, I call it. One postscript before I get back to that story in Operation Hope. My dad had a different path, as you heard from my mother. My dad made much more money than my mother. My dad had more hustle than most people around him. My dad knew the local bank branch manager and thought that was everything, but that branch manager could not make all the credit decisions. My dad never realized that. So my dad would cash checks, bounce checks sometimes at the bank, but he was sweet talked, unfortunately, by a mortgage broker who came by his house and said nice things to him, but didn't do nice things for him, and gave him a hard money loan. And my dad lost the other home that he had. And so while my mother was working an hourly job and building wealth, owning our successive homes, my dad was a business owner and somehow made it but couldn't keep it and lost successive properties, to the point where I had to take care of him in his senior years. And when he passed away, He passed away in a home that I own, actually, oddly enough, an apartment building that I built for him. My dad was brilliant, but he was financially illiterate. And so he wanted to do better, but couldn't. My mother had that education and some seed corn, and is now part of that American sustainability story and has built wealth. And I think is a path for what you guys want to do at scale. So at Operation Hope, we're moving credit scores in our Hope Inside locations, and we're Hope Inside in most of the institutions that are there with you represented today. Just was at Wells Fargo last week, where I started, my experience as a child, meeting with the CEO there, and with Bank of America as their CEO. We're partnering with all of them to do over 100 Hope Insides each. Truist has got a commitment for us to be in 1,000 of their branches, 1,000 of their 2,000 branches. That's not charity, people. That's business. That's them seeing this as an emerging market. Small banks, medium-sized banks, Synovus, Regions banks, First Horizon banks. I can go down the list of Fulton Bank. All these, we've done $1 billion in mortgages with for Black homeownership just with Fulton Bank in Pennsylvania. So this is possible. So we're raising credit scores 54 points in 6 months, 100 points, 120 points in 24 months. Nothing changes your life more than God or love than moving your credit score 124 points, 120 points in 24 months. We are lowering, this is for somebody making $48,000 to $50,000. We're lowering debt by $3,500, $3,800 in a year. We are increasing savings. Keep in mind that 60% of Americans don't have $400 for an unplanned event. We're increasing savings by $1,000 to $1,500. And our work is so effective, Delta Airlines now, for their 90,000 employees, has mandated that every one of their 90,000 employees who go through our financial coaching will get a $1,000 emergency savings account gifted to them, because they see this as such a game changer for the morale and the stability of their employees. And I can't go through an airport without somebody screaming their credit score to me at TSA, a TSA agent, or having the Delta employees thank me for really helping to stabilize their life financially. And this work at Operation Hope is now at scale. And what we're doing is getting the banks out of the no business and back into the yes business. And I'm going back now to a decade and a half in South Central LA in some of our first locate, well, more than 25 years actually, where what Isusu's doing institutionally, we did informally. Copies of utility bills, copies of rent statements, copies of your insurance payment. Because if you're making an insurance payment as a working class person, you're paying monthly, you're paying quarterly. Well, if you're paying monthly or quarterly, I believe that's a form of credit. But it doesn't show up in your credit report. You're paying it on a schedule. If you're paying it on time, you should be given credit for it. Cell phone bills oftentimes aren't reported. More rents payments oftentimes aren't reported. Utility bills are not reported. There's all kinds of credit. And in these neighborhoods that I grew up in, underserved neighborhoods, you have B and C credit providers that don't provide credit. And we don't have time to get into this really, but we have a Hope credit score index at Operation Hope that we partnered with Experian on, where we mapped out every zip code in America by credit score. You tell me your zip code, I'll tell you how you're living. And the data is unimpeachable. And what we found is that the lowest credit score in America is Mississippi, as an example. The poorest state in America is, most unbanked state, Mississippi. And there's only 3% of folks in Mississippi, give or take, that have a credit score above 700. Now, what does that do to GDP or opportunity or aspiration or mindset? And we found that in areas, Black and brown, by the way, and white, that had less than a 600 credit score, 580, that's where all the problems are. So you have in those neighborhoods, and whether it's Black and brown, urban or white, rural, here's what you see. A check casher next to a payday loan lender, next to a rent-to-own store, next to a title lender, next to a liquor store, next to a pawn shop. Can I get an amen? With a church down the street, trying to make you feel a little bit better once a week. And we prophesize differently in those churches, but everybody's going to church because it's almost like the psychological help you need to get through your week when you're living in a 580 credit score neighborhood. Can you rehabilitate that group, get the credit score up, get their approvability up? Can you institutionalize alternative data to do what Isusu and others have done so that it's baked into the system? Can you use technology to be objective versus the people who are subjectively nice to my dad in South Central LA? So that transparency, markets love transparency, so do communities, right? And can you do well and do good at the same time so that things like what happened in the early 20th century with the FHA don't happen again? With robotics and AI, that's happening right now. The changes that happened with horse and buggy to automotive from the 1800s to about 1910, it took 50 years from the horse and buggy to the automobile. We're going from human development exclusively to artificial intelligence with humans running that, hopefully, running those instruments. That will take 5 years. That'll happen before the end of the third Reconstruction. But can we now, when you're being run out of town, get in front of the crowd, make like a parade, can we take this moment and turn it into something positive? AI, robotics, technology, efficiency, because you cannot have a growth or anything without having technology in the center of it. Can you use that plus a desire to do good, plus the future of finance, plus the oversight now the responsible oversight from government that exists today, and create a scale opportunity for all, and embed financial literacy and financial coaching into that process so that you have sustainable finance, sustainable communities. As I just mentioned, all the problems, all the riots, all the police brutality, all of the low GDP, single parent households. I don't, go to the credit score index and look at the Hope Credit Score Index, look some of the examples we have there. It'll blow your mind. You live 20 years longer in a 700 credit score neighborhood than you live in a 580 credit score neighborhood. But what if you could take the positives here? And by the way, check this out. All communities stabilize at 700 credit score. So if we can get credit scores up so that we can get mortgage to be more ubiquitous across the system and create more wealth creation. I was getting all this to say this, that wealth for Blacks is a tenth of wealth of white counterparts. And that is sustained since the first Reconstruction. And in some ways it's gotten worse, actually. The number one way you build wealth is home ownership. And you look at an urban community in France, it's called Paris. An urban community in the UK is called London. I mean, every inner city in the world other than America is the highest value real estate. We put Blacks and minorities in inner city neighborhoods. We don't have time for why and all that stuff. You can probably figure it out for yourself. Other folks move to the suburbs. Well, they feel like they're figuring out with the state of traffic, et cetera, that is not such a great idea. And yes, offices are coming back. We still will have technology, but it'll be hybrid. You will have to come back to offices because, as I said, technology is more efficient. It's not more effective. We cut deals when we actually are with each other. You can sustain business on technology, somebody you already know in the past, but to build new relationships, to sell new ideas, that's why the next time we do this, I want to be in your face so you can feel my energy, I can feel yours, and we can lock arms and I can actually give you a physical hug and not just give you a virtual one, because energy matters, culture matters, and you build culture in person. And so urban inner city communities that have proximity to jobs, transportation, ports, et cetera, are going to be invaluable. Can we create gentrified neighborhoods that are inclusive and diverse? Yes, you can. Can we create an America that where all boats rise, restore the American dream, give folks a path to reasonable wealth creation, home ownership? Because it costs as much to rent as it costs to own. I'm a renter, but I encourage people to own a home. If you own a home, I want you to move out of my house and go do it just like I did. And that banker story led to me running my first business. By the way, when I was 10 years old, put the liquor store out of the candy business. I was homeless for 6 months of my life. When I was 18 years old, for believing a little bit too much in my press, was a little bit too confident. and realized, I mean, I was literally homeless, but didn't tell my mom, she would have forced me to come home and get a job. And I didn't want a job, I wanted to create one. So I had a vision for myself, but as soon as I could, I owned a home. And you know the rest of that story. Now, literally up from nothing. And I just signed a $200 million credit facility with Barings in the middle of the pandemic, Christmas Eve 2021. One of the largest credit facility signings of a person of color or of a Black entrepreneur in the last decade. So up from literally nothing to signing a $200 million credit facility and literally signing individually 650 mortgage documents. Imagine me going through all those, what do you call it, disclosures. Can it be a more efficient process? Yes. Can technology being used as a force for good? Yes. Can you bake in social justice through an economic lens in this period where we're going through so much transformational change? Yes. Can you be the forces for good in the midst of that? You have to be. Because no one else is going to do it. In fact, no one else is doing it. And most people don't even understand the conversation we've been having today. Most of the country, most of the world is not financially literate. And you're in a very specialized area. You're in an area that requires enormous understanding of the subject matter. It's relationships. Most of you in the room, you know each other. And that's why I could call off so many names of people I know are speaking there. I knew the roles you had 2 or 3 jobs before, because it's a relationship capital. But if all of the wealth is up here, going to country clubs and going, why do we go to Harvard? Because Harvard is 10 times better than State University? No, because the class at Harvard of 2023 is going to hook each other up for the next 40 years. It's relationship capital. That's why you go to country clubs, not just because you want to play golf. It's why all of this here is relationship capital. And people do business with people they understand. And then you have a lot of another group over here should be just as brilliant, but don't have that relationship capital. If you, again, as I said earlier, you hang around 9 broke people, you'll be the 10th. I'm going around this country and around this world. Just had a meeting with the Wall Street Journal, having a meeting, trying to get them to do financial literacy for all. I'm really close. Dow Jones, I'm having a meeting with all these big companies, institutions, trying to create a new movement, a new coalition of the willing in the suites to match the movement we had in the 60s in the streets, to create opportunity at scale, to be a consciousness on capitalism. But I can't do it alone. We can't do it alone. Sandra can't do it. The government can't do it. It needs, not alone, we need you. So we need you to huddle in these next few days. We need you to roll up your sleeves. We need you to understand that your legacy is being created right now, because it's about what you give, not what you get. It's about what you do for others. And you can do it. We're all, let's admit, frustrated teachers, all of us. What can you do to teach other providers? What can you do to be a teaching agent through your solutions and embed new frameworks and new platforms into the system so that it does good without having to consciously think about it. It does good because the system is good, not because a person in the system happens to be good and decides to do the right thing. What if we embed these best practices, this vertically integrated system I just mentioned, into what you do? I'll leave you with this. I'm out of time here, and you never want to be the old guy in the club. I have to believe I must be on mute, because I know you guys have to be laughing at some of the stuff I'm saying, which is fine with me. But you never want to be the older guy in the clubs. I'm going to go before you kick me out. But I heard somebody just took me off mute, so I do trust that there's energy in the room. I'm going to give you an example of what you can do. After George Floyd, I got a call from a friend who founded Shopify, which is the second largest e-commerce company in the U.S. His name is Toby, one of the wealthiest men in Canada. And he asked me to speak, very much like I'm speaking to you virtually, to his crew. And we talked about all the stuff we're talking about here, but from an e-commerce perspective. And at the end, he said, John, what can we do here at Shopify? And I said, oh, I don't know. Help me create 1 million new Black businesses in America? And he said, send me something on that. So I did. I wrote him a little note and emailed it to him, and I heard nothing in a week, and I figured, okay, well, that didn't go well, crickets. So I sent him a note saying, thanks for consideration, Toby. I know you're busy. Thanks for trying, and see you next time. Send. And he wrote me a note back and said, John, what are you talking about? I said, yes. Here's what you can do to help me with technology, get my stuff out of the spam folder. It had gone to his spam folder. Sorry, it had gone to my spam folder, and I never got the note. And I went and found the note, which is one line. I'm framing it. And that led to a $130 million commitment over 10 years, create 1 million new Black businesses in America. We partnered together, high tech and high touch, Shopify and Operation Hope. And there's only 3.1 million Black businesses in America. Just want to give you some texture here. Most of the businesses don't have an employee, back room, technology, administration, et cetera. Just to give you some texture here. 3.1 million Black businesses in America. We've created now, in 2 years, 290,000 Black businesses in America. Operation Hope, 8%, little under 10% of all Black businesses in this country created through this partnership, non-government. Now we partner with the SBA. The administrator is fantastic there. We're partnering with all kind of institution in the government, and now it's getting real scale. And we're ahead of schedule to create 1 million new Black businesses by 2030. We're ahead of schedule. And these businesses have technology, they've got efficiency, they've got back rooms, attorneys that are lending 2 hours of their time, accountants, marketing professionals, technology, IT people. We're finding these businesses have more jobs, they're more likely to employ, they're more likely to be in sustainable industries. They're building income streams, which is a way to build wealth and not just cash flow. And so this is an example of what one organization can do in a parallel space. What can you do? You're in some of the biggest organizations in the world, certainly in America, which is the largest economy in the world. You have Aspen there, which is one of the best thinkers on the planet. How can you be the change you want to see in the world? Watch how you live your life. It may be the only Bible anybody else reads. I'll see you in heaven.
Right. Thank you, John Hope Bryant. That was amazing. So my name is Anne-Marie Pippin, and on behalf of FHFA, John Hope Bryant, we were so thrilled you were able to join us and kick off this extraordinary event. You and Director Thompson have really set the stage for the work that's going to take place this week during the TechSprint. You spotlighted the issues, but also given us hope for the future and inspiration to work together to innovate. And now we will invite to the stage a panel of experts who will discuss the growing role of data science in housing finance. This subject feels like the perfect way to kick off the sprint and spark creativity on how we can use data and technology to advance the mortgage ecosystem. Let me introduce our moderator for the session. David Ehrich is the co-founder and executive director of the Alliance for Innovative Regulation, or AIR. AIR is a nonprofit focused on the modernization of financial regulation, both in the US and globally. David has worked in banking and payments for over 20 years, including at McKinsey, JP Morgan Chase, and American Express. He's a fintech advisor and investor, and previously was a member of the Consumer Advisory Board of the CFPB. And he's a passionate advocate for financial inclusion. Please welcome David to the stage.
Thank you, Anne-Marie, and thank you to all of you who are here today. By a show of hands, let me see how many of you have traveled to get here today. Traveled more? Yeah, look at this. This is amazing, right? So we have a whole community here of people who are giving of their time and energy and have really moved heaven and earth to get here today. So these are the sprinters. These are the sprinters. So welcome, sprinters, and thank you very much for your contribution. I want to take a moment and thank Director Sandra Thompson for her vision and her leadership in creating the Office of Innovation. The commitment is really just the first step in being able to establish how technology can be used more effectively and more efficiently in the mortgage application process. As Director Thompson said, many of the processes that we're working with are paper-based, and this makes this process cumbersome, it makes it difficult, and in certain ways it makes it exclusionary. I also want to thank Jason Cave and also all of the members of the Innovation Office. We at AIR have been working closely with the innovation team, and it has been an incredible collaboration, which is culminating with this first event, this TechSprint, that all of you are participating in. So thank you very, very much. We have an amazing panel today. I loved the quote that John Hope Bryant said about it doesn't feel historic when you're sitting in it, right? But today is, in fact, a historic day because we are on the cutting edge of figuring out how to integrate technology and the great advances that we're making in technology into our regular life workflows, our regular ways of doing business. We have an amazing panel here today. And what I would love to do is just take a few minutes and have each person introduce themselves. When you think about the time that we are in right now, when you think about what's happening with generative AI, when you think about the incredible challenges that we're facing, both risks and opportunities, this is a moment of great uncertainty. And the people that we have on the stage today are probably some of the smartest minds who are thinking the very deep thoughts about how can we harness these new technologies for good. And so I'll just go down the line. Melissa, do you want to start and introduce yourself?
Just a quick introduction?
Yes, please.
Hi, everybody. Melissa Koide. I'm the founder and CEO of FinRegLab. We are a DC-based, nonprofit, non-advocacy research organization, and I'm going to save a little bit of my telling you who we are because it speaks to what I'm here to talk to you all about today. But it's great to be here. Thank you for having us.
Hi, good morning, everyone. I'm Joanna Smith-Ramani, and I'm the co-executive director of the Aspen Institute Financial Security Program. Our work at Aspen is around our name, really trying to make sure that we have inclusive wealth building opportunities in the U.S. for all Americans.
Hi, everyone. I'm Michael Akinwumi from the National Fair Housing Alliance. I'll tell you more about the National Fair Housing Alliance in a moment. But I come from a mathematical sciences background, so I've developed and deployed models in health, insurance, banking, and now in housing. So the work that I lead with my team at the National Fair Housing Alliance focuses on making sure that many of the benefits promised by technology, AI, machine learning, gets delivered to housing consumers.
I'm Pete Carroll. I'm with CoreLogic. I think probably most of you know who CoreLogic is, probably the largest provider of single-family residential data and analytics. I lead the public policy team for CoreLogic, and I've had a very strange career of management consulting. I was a fintech entrepreneur, government regulator, and now a public affairs executive, all in the housing finance space for my career. So I'm just delighted to be here as well. Thank you.
Thank you all. Really appreciate you making the time to be with us today and to set the stage for the TechSprint, which is to come over the next 3 days. We talked a little bit about how exciting this time is because of the emergence of AI and generative AI and how much that has changed the landscape in just the last couple of months. And while that's actually a very exciting and sexy new topic, one of my favorite comments is one by Melissa Koide, which is, "It's the data, dummy." And so, Melissa, at FinRegLab, you've done a lot of work doing research around AI and predictive modeling, and one of your key learnings is that it's really based on the data. And I'd love for us to kind of anchor this conversation today on the data, both its pros, its cons, and how powerful it is.
So I'm going to get to that. Thank you. It is the data dummy. But I also, I want to tell a story because I want to get you all a little jazzed. And I also want to find out if John Hope Bryant is still watching this. So I'm going to tell a story which gets to the point about where we are frankly, when you're in the moment, you don't realize you're a part of history. It's 1998. I am a young staffer at that point in the U.S. Treasury Department, working for Michael Barr, who was the DAS for Consumer Policy, Community Policy, and we're waiting for John Hope Bryant to show up for a meeting, who's already, John, you better be watching this, like 25 minutes late for a meeting. He literally shows up, he puts his cowboy boots up on the desk, and we have a conversation about wealth and the lack of wealth in Black communities. And it was one of the most sort of invigorating, as listening to John usually is, but conversations about just how important this is. But that, we go back to 1998, and we have been focused and trying to understand how do we build assets and wealth opportunities in low-income communities for now how long? And we're finally, I think, starting to figure this out. Another piece of this is a conversation about data. And I think about you, Director. I mean, you said at the FDIC, head of risk, supervision, you want to make sure that when you are making loans, whether it's a short-term loan, a medium loan, a loan to a small business, or a mortgage, that we've got the risk assessment right. And we want to make sure that people have opportunities, but we also want to make sure that we're not giving people loans that they can't repay. And part of really understanding that means we're coming back to the data. And one, making sure that the data is giving us the full picture, and making sure that the data is actually representative of populations who we have historically excluded. Our policies, our government policies, our commercial practices and policies have excluded people from wealth-building opportunities, and that plays out generation after generation. But that's in part why we get so excited about data, and yes, more complex analytics, because we actually can get more insights about people who we just haven't even had in our data population. We have 50 million adults in the US for whom traditional data that we use, credit bureau data, is unable to credit risk assess. And so I've been in and out of government. I've actually spent time in the asset and wealth building world. And that's why it was exciting. I was most recently in the Obama administration, sitting inside government when we had fintechs and advocates, and everybody coming in to us in the Treasury Department with their pitch and their perspective about, it's the end of data privacy, or data and, I'll say it, things like virtual currency are going to solve global financial inclusion. And it's really challenging as policymakers to understand without empirical insights about what the benefits and what the risks to consumers, to people, to households, to the financial system, to the individual firms who are using that data or that technology. How does it work and where are the benefits? And then how do policymakers evolve the rules and laws so that you actually do get those attendant benefits, but then you're mitigating the risks.
And you should have seen Melissa's face when I came into her office with an abacus. Because
I have stories to tell. I'll save that for another day when you all came in. I had some good stories. There are many good stories we have. So anyway, so the punchline here is FinRegLab was an organization that I stood up after leaving Treasury, spending the summer talking to regulators, colleagues who I'd worked with about, what if we put together a research organization that sought to get after these questions around data and technology use, not as an advocate, but really to build the research, to engage industry so that we generate those insights that are ultimately informative for where the risks and where the benefits are. And things like this TechSprint, I think, are critical to really evolving that conversation. So kudos to FHFA for stepping in and doing this themselves with great partners, of course. So the last thing I want to say about it's the data dummy. It is about the data. It's about data that offers more nuance. It's about questions and conversations about what kind of data do we as individuals and we as society want used for important decisions like credit assessments. It's also about making sure that the data that we're using is fully representative, which I mentioned. So we've done some of the first public-facing research looking at cash flow data, that is the financial insights from transaction accounts. We're actually now doing some of this research in Kenya. Interestingly enough, they have a different way of facilitating payments, but looking at the data there. And what we found are these types of data are actually empirically proved to be indicative of risk. When they're used with existing credit bureau data, these data are instructive in providing an additional insight over and above what bureau data or FICO or Vantage scores would tell you. We also found, we had loan level data from 5 lenders. These lenders were able to serve populations in low to mod income communities, in minority majority communities, and these are individuals who otherwise, it was small businesses and consumers who otherwise would have been turned down were it not for the use of this cash flow data. And importantly, the data are independently, that we looked at, were independently predicting risk. We were not seeing the correlations with protected class populations, which is a really important piece of a disparate impact assessment. So it's quite encouraging, it's nuanced, it's getting beyond, we believe, sort of correlations with income or wealth, which is essential when we're trying to bring more people prudently into products and services. We didn't get to look at mortgage, but hey, there's good work to do there, and I know you all are really sort of advancing that conversation. All right, that's enough, but hopefully that, one last thing, it's the data dummy. We all get excited or petrified about generative AI. It's the data dummy. What are the data that are going into it? Can we understand what are the data that are being used? That's a whole other panel conversation, I suspect.
So you as hackers and sprinters today are going to be asked over the next couple of days to really figure out how to improve the mortgage process. And you're going to be thinking about data, what kind of data to use. You're going to be thinking about processes, what is the way to best use that data. You're also going to be thinking about impact on policy, right? So all of these different spheres are coming together, and we have representatives today from each of those spheres. Pete, you work with CoreLogic, and CoreLogic is a data specialist. And I wonder if you could help us understand what are some of the key trends that you're seeing in data today, and some of the things that the sprinters should be concerned about or aware of as they start on their journey over the next week.
Absolutely. So I'm going to preface this by saying I was lucky to have a mentor who used to say to me that history can be very boring, but also very instructive with respect to how tech innovation can take time, touch, and cost out of a transaction. Which, if you're taking time, touch, and cost out, driving down costs, increasing profitability, the marketplace. If you believe the primary mortgage markets have competition, which I do, price equilibrium sets in, and you see that pass its way through to consumers, which is important. But then also importantly, responsibly expanding mortgage credit availability and access to home buyers, right? You don't want to just expand credit availability. You want to do it in a way that ensures they still have the ability to repay, as Melissa was mentioning. And that, if we could do that successfully, that's how we're going to drive greater equity in home ownership for Black or Indigenous or people of color, BIPOC home buyers. And then simplifying the mortgage experience for the consumers. This is a Byzantine process, buying a home, financing a home, and that's a big opportunity. My mentor would drop a big stack of books probably that high in front of me and say, read to the history. I'll spare you all that because we don't have the time. But I will frame this as kind of 3 stages of evolution where I'll skip the first, I'll just mention the first 2 and then talk about the third for a minute, which is, the first wave, and I think everybody knows this stuff, but I think it's an important frame to keep in mind. The first was, we've been doing AI for over 30 years in this business with the advent of automated underwriting systems. The launch of DU and LP in the mid-90s was the first use of expert systems technology, a different type of AI, but it was AI, rules-based systems, expert systems. And they both were critical in terms of they really were the first kind of wave of tech innovation that ushered in scale economies into this business that just opened up mortgage markets over the last 30 years for middle income families. So the 80% to 120% area median income probably skewing more to the 100 and above, but still, that was not an easily scalable segment of the housing market that has become entirely scalable and has really kind of created what remains today the traditional underwriting system, right? When we think credit score, credit history, DTI, loan to value ratio, compensating factors among them. That's really, from the advent of desktop underwriter and loan prospector, and you're going to see this theme where the GSEs really kind of lead the way on these technology innovations. Second wave I'd probably describe as the early ML, AI, and data quality and integrity phase. That would be, in my view, kind of starting around 2012 through to about 2012 up until COVID, I'd say. Again, the GSE is leading the way. I mean, I think when the mortgage meltdown and financial crisis of 2008 hit, it laid bare for everybody how important data quality and integrity is. I guess it's about the data dummy, right? Back to this theme, right? But to me, what was important is how we kind of answered the call. And that was the advent of the Uniform Mortgage Data Program, which was incredible in the way the GSEs aligned their transactions, their data formats, data definitions, and then and more importantly, tied that to the rep and warranty framework, which created confidence and trust in the system, which I think is another theme. So that's great, but that leads to the third, which is where we are today, which is I'm going to call it the post-COVID-19 age of AI and ML. All right, it's here. We're ready for it, and it starts with futurists have been predicting this exponential growth curve in technology computing power, and we're here. It's there. We're here. It is here, and it is becoming amazing the types of models we can create. And so just to me, the kind of top three, Melissa already hit on one of them, but I'd say the top three major trends we're seeing: alternative credit data, which I think you have to talk, so what I mean by that is first rental data, and I tend to separate out rental data as one set of considerations from utility data. And by utility data, I think that gets a little confusing for folks too. That's anything from cellular, wireless, landline, satellite, cable, and utilities like gas and electric, right? Those are histories that are getting collected now. They can be imputed off a bank statement. They're being collected by the credit bureaus. And these are being used both in their traditional underwriting context as a method of doing digital source verification of borrower financial information, so verification of income, employment, assets. And it's being used in emerging underwriting techniques like cash flow underwriting. So a very important innovation there. Second one I would say would be the kind of digital collection and visualization of interior and exterior property data. So this is really on the cutting edge here, but it's using not only pictures but image analytics, right? So that type of AI and to really infer from pictures of an interior and an exterior what's going on, what types of materials, their quality, what types of appliances are in the home. And tying that all together visually, right? It's very important, and that's really kind of driving this innovation of digital hybridized, the hybridized digital appraisal, where you have and workflows, right? Where you can have one party collecting all this digital information, another party doing the independent appraiser doing the assessment of condition, value, and marketability. And then the third, which I don't know gets mentioned as much, but I think it's a really spectacular one, is geospatial data and weather data, right? There's just quietly, there's just been this massive opening and public data availability of weather and spatial data, and this has enabled breathtaking physical risk models that can assess the climate-related financial risk down to a property level. So you can start to understand how, with the increasing frequency and severity of natural hazards that are occurring, how the uninsured loss component of that, which is increasing, right? Increasing, we're seeing underinsurance, uninsurance for certain perils, how that can affect everybody in the ecosystem, most importantly homeowners, but then increasingly this kind of notion that, well, these losses could start to flow up the mortgage chain through servicers, PMI, credit risk transfer investors, and the GSEs themselves. And so really understanding that, I think, becomes very important. So those are the kind of three major themes I would say I see, and what I would say is important for this TechSprint is to kind of tie it back to those three benefits, right? As we kind of think about and ideate on all the amazing solutions this group's going to come up with, tying these solutions back to these three themes, and then thinking about the challenges around things like scale adoption, equity, and home ownership, as we're talking about, is going to be very important. But I'll stop there.
That's great. And, you know, part of what we're trying to do here is really stimulate your thinking, right? Each of you have a depth of expertise in your particular area, but the teams that you're on have been carefully curated to ensure that we've got people representing all different parts of the ecosystem. So this is an incredible opportunity for you to be exposed to and learn about other parts of the ecosystem that you may not have as much exposure to. I think, Michael, at the National Fair Housing Alliance, you have been using data and AI and new technologies in really innovative ways to uncover gaps in fairness and in access. And I was wondering if you could share with us a little bit about the 5 priorities that you have. And also, as Michael goes through these, I want to really invite the rest of the panel to jump in and engage in these very meaty topics, which each of you will find very powerful as you begin to assess what project you'll work on for your sprint.
Yeah, thank you, David. Before I share the 5 priority areas, I actually like to just briefly comment on what Pete said about the history. I know he was sharing the history of the data, the technology, and all that, right? But given that I'm from the National Fair Housing Alliance, and some of you might be thinking, how did I make the strange leap from a data science background to joining a civil rights organization? So I think in a moment when I tell you a brief history behind some of the data in housing, then it all may make sense to you. So the National Fair Housing Alliance is a civil rights organization. In fact, the only civil rights organizations in the country that is solely dedicated to eliminating all forms of housing and lending discriminations, and also making sure that everyone, regardless of their religion, sex, race, and color, and other protected characteristics, have equal and equitable economic opportunities. Now, there's no way we can talk about ensuring equal access to economic opportunities without really looking at the history behind the data. Because when you talk about data science, of course, the focus is usually on the data or the technology or the science. But one of the things I've come to learn, especially when you look at other opportunity areas that are connected to housing, for example, health, credit, transportation, and even renting, all these are connected to housing. It is really important that as a data scientist, you actually pay attention to the history behind the data, because there is a lot of things that go on that create the data you're going to be working on. And if you are not intentional about looking into the data, like Melissa mentioned, how representative the data is or the overall quality of the data, then you may miss a lot of things in building solutions that you think or that you expect should provide equal and equitable access for everyone. So now, that said, it is because of that history that we actually have 5 areas of priorities. One, I'm going to mention briefly those 5 areas, then I'll try to go into details in terms of some of the work we've done. So the first area of priority for us is algorithmic auditing. And the second area is algorithmic fairness. And the third area is privacy, or you can call it data privacy or algorithmic privacy. And the fourth area is computer vision. And the fifth area is language models. And I'll go through these in order. So when we talk about, so the first one, which is algorithmic auditing, of course, we are all here because we believe in the benefits that come with technology. And that's not to disregard many of the risks that are well known that are associated with technology. But then if we really want to identify or assess risks that come with technology and make sure that those risks are eliminated, it is really important that there is a framework that we can actually follow to identify different areas where risks can actually come in. And I'm happy to tell you that overall, there are 3 areas you should be looking at. And one, you want to think about the data, right? So because this is one of the areas where bias, discrimination, prejudice, and all that can creep into the solutions that you are developing. And the second one is the math. Well, you might be thinking, well, math is always objective, or math does not have opinion, but being a math student myself, or having my PhD in math, I know that there's a lot of assumptions that go into math. So if care is not taken, the math you're trying to lift intelligence, you're trying to use to lift or extract intelligence from the data could also be biased. And the third area is actually the people who are developing the model. So that's the third area where you need to pay attention to. And that's why at the National Fair Housing Alliance, we have developed a framework that we call PPM, which is a purpose, process, and monitoring. So it covers all the different areas that you will look into as a data scientist or a machine learning professional if you want to identify risks that are associated with many of the technologies that you're developing. For example, when it comes to deciding what models you use as a data science professional, there are a lot of questions or subjective thinking that actually goes into that. And this framework will really call into question how you arrive or how you decide what model you're using or what metrics you're using to evaluate the performance of your model. And also, it's not uncommon for data scientists to think that you build a model once and you reuse it over and over. But we've seen that if you don't monitor the models that you've deployed, then the quality of the model, the performance of the model actually deteriorates. And that's why in the framework, we also talk about different areas that you need to pay attention to monitor, to make sure that you can sustain the quality and the performance that you see in the model. And the second area that I will go into is algorithmic fairness. So the other time I was talking about the history behind housing data. And I've seen this firsthand by looking at, for example, many of the publicly available data, for example, the Home Mortgage Disclosure Act data, and even some private data that we got access to. We see that there's a lot of underrepresentation or what we can call data bias. And based on that, there is a need to be intentional about looking for technology or algorithms or methodologies that, one, could help remove bias from the data, two, could also help remove bias from the algorithm, and also the policy or the implementation of the outcome of the process. In fact, right now, I think for the past 5-6 months at the National Fair Housing Alliance, so we've been testing some publicly available or open source algorithmic fairness technologies. I'm sure for those of us who are data science professionals in the audience, if I mention adversarial debiasing, I hope that actually rings bells. So we've been testing that, and also a group of techniques that we call distribution matching techniques that we also test to see how they could help to constrain some of these models to be to have good performance and also to be fair. And when I talk about performance and also fairness, those of us who are in the audience, you might be thinking this dual objective cannot be achieved. But again, based on the research we've been doing, we know that you can actually do joint optimization on your models. And with that joint optimization, you'll be able to achieve the twin goal of having a very good model that is accurate. And when I say accuracy, I'm really referring to the performance, and also that is also fair. And fairness here is really in the lens of disparate impact. And
Michael, one of the challenges about the bias in the data is that there's many segments for which we don't have data. And so one of the opportunities for you as you're going through your TechSprint is to think about what are new sources of data, and can you actually add that to the public catalog?
And can I just, I was just going to add in particular, because it hasn't come up much today, is in particular for like indigenous communities in the US, right? There's a small percent of the population. They never show up in national surveys. There's quite a bit of work that we've been doing with different leaders in that community and with the Minneapolis Fed, which has the Center for Indian and Community Development, I think I said that right, CICD, on how they show up better and where are better data sources. And in particular around ownership, this is a really big issue. So I want to call that out because I think someone brought it up, maybe Pete, but otherwise, like, it will go unnoticed.
Yeah, thanks, and thanks for mentioning the national survey data, which is one of the data sources that we have looked at, and we also see what many of the limitations are. And talking about, thinking of or trying to be intentional about building responsible solutions, but you just don't have the data. And that is why in our third area of priority, which is computer vision. So we're seeing, okay, well, for example, when it comes to the Fair Housing Act, you want to make sure that you're developing models that are not discriminatory. But then you also need access to the data that you need to test the models for disparate impact or disparate treatment, right? And that's why last year we looked into a computer vision model, and we tried the model that we looked at in particular, which is really the third area of focus for us, is looking at how they can predict or infer, just looking at images, how they can infer race, color, and also age. And of course, I'm going to quote Melissa this time around. I hope I get it right, which is like, data is the dummy, right? And what we found is that the images that you actually, the data that you have really determines the performance of the computer vision models that were reviewed. Now, another use case that we considered when we reviewed computer vision model in housing is automated valuation model. Because we're actually seeing many of the benefits that come with computer vision model when you want to extract information about the interior conditions of the property and the exterior conditions of the property. And when we talk about closing the racial home ownership gap or wealth gap, it is really important that we get the valuation of the property or the home right. And we're seeing more and more use or uptake of computer vision model in that area. So the model we developed, again, is still limited by the quality of the data. And the other area, the fourth area, is privacy. So I've been talking about disparate impact, disparate treatment. In fact, about 2 years ago, when we started this algorithmic fairness research, we realized that there is a tension between privacy and the civil rights principles, right? Because on one side, you have a team of model developers that don't have access to the data required to remove bias from the model. And on the other side, for example, in the model risk management team, you want to make sure that you only deploy models that are fair, that meet the fair lending compliance expectations. So what we did was to review privacy-enhancing technologies. For example, we look at differential privacy. We looked at homomorphic encryptions. In fact, we have a paper that should be out later in the month reviewing all these different privacy-enhancing technologies, what their limitations are, and also their usefulness in housing. And the last area that we've been looking at is large language models. And of course, many of you that are familiar with ChatGPT, or those who are really into like natural language processing, you may actually see that before ChatGPT became a trend, there has been a lot of work going into large language models. But the way we are looking at it is because we are seeing more use of or adoption of language models when it comes to describing properties. Like if you go to a rental listing website, you may see that many of these technologies are being used. And so about 4 months ago, we started doing research to see how those technologies can be used. Large language models in particular could be used responsibly, and also to understand many of the risks associated with them. Now, having said this, having talked about those 5 priority areas, algorithmic auditing, algorithmic fairness, privacy, and large language models, and also computer vision. There's one thing that I just like to leave with the sprinters, and in fact, this is coming from an event that we just hosted at the National Fair Housing Alliance about 2-3 weeks ago, which is about the people that are developing the data science solution. It is very, very important that you have a diverse team. And when I talk about diverse team here, I'm not looking at it only from the racial lens, but I'm talking about looking at it from the experience. So within your team, there's a lot of different people with different background and who have different perspectives when it comes to the solution you're trying to develop. And our own experience, especially from the Tech Equity Hackathon that we just completed 2-3 weeks ago, the winning team was actually the most diverse team, which means the team that worked together, learned from each other, and listened to each other to make sure that they developed the best responsible solution.
Good rules to live by, right? So listen carefully, right? You know, the teams that you have, like I said before, are carefully curated to bring in a diversity of experience and perspectives. And so we're hoping that that will really increase the richness of your exploration. You know, I wanted to turn to Joanna. We have a very powerful opportunity here to bring a policy lens to this. And I think for many of you, you recognize that having a home and building equity in your home is one of the primary paths to creating wealth for middle-class Americans. And one of the challenges that we've had is that, you know, half of Americans aren't creating wealth. And how do we address that? And the Aspen Institute has put a lot of time and effort and a lot of brain cells into this. And you've just recently released a new report. And I was wondering if you could share with us.
It's really big. Thank you. So we just released a new report that's really coming off of a career of my work and my colleague Ida Rademacher's work, but in particular off of the last 3 years of looking at, in the current kind of world we live in and climate we live in, literally the climate that we live in, and the diversity of our country, et cetera, what is a new wealth agenda? What does it really look like to build wealth and financial security in the country? And so we did a series of starting with consumer perspective on what are the functions of wealth in your life, and then how does that dictate the kind of wealth people need and the kind of then products and services and financial service environment they need to be in, to understanding where debt fits in. I know, well, this is about a different kind of debt. This whole sprint is about mortgage debt. But of course, debt in our country is a huge hindrance to any kind of financial security, and in particular is, you know, the biggest cause of the racial wealth gap in our country. So we did work on debt, if you're interested in that. We kind of looked across the world at what are 101 inclusive solutions for wealth building. Like, there's a lot happening, and can we start capturing the buckets that they're in? And then ending with this last piece, the new wealth agenda, which has 8 different objectives around wealth. I'll say the 8 just because I think they're important. Again, I was kind of like sitting here today, well, even on our prep call, thinking like, okay, I'm not a data scientist or a mathematician. I started as a houser in my career, but I am no longer technically just a houser, people who do housing work. My husband is in housing finance, so maybe I can pretend. But then I realized, no, I'm kind of here from the consumer perspective and reminding this group of sprinters, this really talented group of people that could be building anything, but have chosen to help us really think hard about this problem. Who are the other stakeholders to be considering, including the person themselves? So just to say the 8 objectives, because this is all going on in someone's life, it's financial stability and resilience, right? Like half of Americans right now do not have positive cash flow in a given month. So most families we are talking about don't have enough to add more expenses to their monthly balance sheet. 2, debt resolution, I already mentioned. 3 is around startup capital for life. Like, what do we do for the youngest people in our country around getting them invested in the market early? 4 is around wealth building career pathways. That's really around student loan debt. Again, a super big issue for this room to consider. I just saw a report that, you know, because everyone's going to start making their student loan payments again, people had done really well in this period where they weren't making them. Credit scores went up. They could leverage further. Many people bought homes that they weren't going to be able to do because of student loan payments, but now the payments are coming back. So what I actually was thinking about the work that I was doing on your advisory board of like, what's going to happen now to people's kind of full debt portfolio, and how are they going to be making those monthly payments, and how will that look now for different kinds of mortgage applicants? But anyways, the 5th, I encourage you guys to dig deep into, because it's all about equitable homeownership, and not just the financing of it, which is where you sit, but the other parts that are happening around it. 6 is retirement security. We're like deep retirement people. Seventh is shared ownership, another area that I'm interested in bringing up for you all because there's a emerging set of work in this country on how we democratize access to wealth. And it isn't just kind of our country's tradition of I own my thing and Melissa owns her thing and David owns his thing. But it's like, actually, can we start having parts of things so that we can get more wealth over time and kind of build small wealth to big wealth? This has been happening in business ownership for a good amount of time, though it's small scale, but there's much more examples of where this is happening in the residential market, or in the real estate market, I should say, both commercial and residential. But there's a huge financing problem, both like at scale and for the individual, because we're not used to that kind of underwriting and to that kind of risk management, but it's necessary to get this like 50% of folks that don't have positive cash flow into ownership. So I'd like to draw your attention to that. And then the last is around de-risking investments and protecting assets. So that's in the paper, but just a couple other reactions could I give to folks of things that I would be thinking about if I were talented like you enough to be on a team to develop something smart like this. One is, Pete mentioned I don't know what you called it, geospatial data and weather. That's like so important. We're starting quite a bit of work on climate change and climate resilience and what that means for wealth and financial security. I'll also just say that, we already know there's a lot of climate injustice, and where the risks are highest for climate issues is where poor people already live. So if we're using that as a layer to measure risk and to understand reliability of a mortgage or a potential appreciation, that's also true, but that also could layer in more discrimination and harm. So I don't know what you do with that, but I think that's really important for you all to consider, especially where we're not even getting insurance in certain parts of the country anymore. The second is around shared ownership, which I already said. The third thing I wanted to mention, and again, I'm not housing finance person, so I will say that again, but I am in the world of financial services, and one of the places where I think technology has all the potential, but then it fails in the streets, and I do work in financial inclusion, is that the kinds of financial institutions that families that I'm most concerned about getting access to good mortgages that actually yield financial security and benefit to them over time, is that the kinds of financial institutions they trust going to are not the ones that are always in the kind of they aren't as technologically sophisticated to manage all the things we are trying to do, right? So community development credit unions are not as far ahead as what a Wells Fargo could process. Minority-owned banks are not as far ahead with their platforms as a JPMC is, right? It's just kind of what it is, and yet these are the kinds of on-the-street financial service providers that people are willing to go to, that they trust, that even though you're trying to create efficient, inclusive, low-cost processes, still need the one-on-one deep touch hand-holding to get through the process that they've never done before. So I would just consider them as users too, right? It isn't just me as a potential buyer of a home, but who do I go to in the community? Who are the homeownership counselors that I work with? What's my ecosystem that makes it work?
And one of the things that we've created for the teams are personas. So these are examples of real people, individuals that could be impacted either negatively by our current system or positively by some of the solutions that you'll provide. And these personas are meant to provide exactly this point of entry into a consumer's personal experience and the ways in which you could help them directly. What I wanted to do, I want to just make sure, is it okay if I take some extra time for questions? No, we're cutting off? All right. So what I wanted to do was just take a minute and think through some of the implications of what we've been discussing today. So for example, if we could actually assess risk better by using better, newer data, could we remove some of the barriers to entry? So one of the conversation topics that we had spoken about earlier was the idea of perhaps lowering or limiting the amount of a down payment based on the data that an individual presents. And I'm wondering, as you think through what are some of the opportunities here, what are some of the out-of-the-box ideas that that this crowd should be thinking of as they go into their sprinting?
Well, I think some folks are doing, I mean, I'll mention another example. I think John Hope Bryant mentioned the work that they're doing about this, but there's a company called Ready Life run by Ashley Bell, based out of Atlanta, that might be worth Googling as you guys are working this week. But his work is to do a little of what you're saying, is using data, using individuals' rent payment history, some of the utility stuff Pete talked about, to say what can this person essentially afford, and then create a mortgage based on what that monthly payment is to afford, because as I mentioned, like 50% of Americans are really struggling. So additional costs are just not possible, but we do need to increase homeownership.
It's a new version of financial engineering.
Yeah.
Right. Pete?
So I have a really strong opinion about this, which is I don't think we pay enough attention to the supply crisis we have going on in the country, right? We can think of all sorts of really clever ways to optimize down payment assistance and the like, but if there's no inventory, right, there's, especially at the lower price points where there's a real dearth of inventory available, it's the sound of one hand clapping, right? So I would say thinking about ways we can use big data to both, to inform state and local and federal policymakers, local stakeholders who are involved in the development of single-family entry-level housing for home ownership, and the mortgage banking community on how to align efforts to get new inventory into the system and use the knowledge of what those consumer demand preferences, the drivers of those demand preferences look like, to design our special purpose credit programs or other affordable mortgage lending programs around that activity. I'm saying too many times I'm seeing a mismatch between the programs going out to market and the actual supply initiatives underway, and that's a
great
bad
point.
Yeah, we want to fix that.
Can I just quickly add to what Pete said, that there is a crisis in small dollar mortgages right now? So there's there's huge supply issues. We talk a lot about that in this because we'll never get to affordable homeownership without it. But like the $150,000 mortgage doesn't exist because it's really costly for like a big bank to go ahead and do. So, but where there is that supply, there are buyers who could get it, but they can't finance it. So that's an example of the interaction between the two.
Do you want me to go next? Okay. Three things. One, I think that the process around identity verification and also mitigating fraud is getting increasingly complex, and where data may be instructive, especially for people of more modest means who maybe have been moving from one rental place to another, the address is a critical element of are you who you say you are, which is required for know your customer expectations for even getting into the financial system. And so where data insights may be helpful there. I do think this point that Joanna calls out about people going to the local banks or credit unions that they know and how those smaller entities are or are not able to really leverage new types of data, frankly, even building their own underwriting models, let alone these big questions of how they may or may not be able to partner with third-party vendors who provide some of that data and tech. Those are really important areas. And then not everybody is gonna, make every single mortgage payment. I mean, we are talking about people who are of more modest means. And so really thinking about where data insights may help to identify sort of early signals where somebody may be potentially going to be in trouble, like you see changes in income. So this gets to the servicing aspects of, managing a mortgage and the extent to which lenders can potentially use those types of data insights and more complex analytics to really help somebody before they get themselves.
To build resiliency.
To build resilience and to be able to maintain that home.
Michael, any last thoughts?
Well, I'll say when it comes to having a last thought, right? So I'm hoping that we can, especially for those who access credit from, companies that probably are lagging behind in terms of like the data or the technology. I'm hoping there will be a solution where you can actually decide or come up with algorithms to underwrite such categories of people. Because from my own experience, I know for a fact that when you look at alternative data, you can actually use that to make assets or to break what I'm going to call the credit box, right? So hopefully at the end of the sprint, we're going to have on one side the credit score, but then there will also be alternative credit score, because many of the bottlenecks around having access to credit is actually related to the traditional credit score. So we have people that are not visible on the credit report or who have thin files. And if they are accessing credit not from the mainstream financial market, then it's also important to consider them as you build your alternative solutions.
Thank you, and thank you, all of you. I want to leave you with 3 points as you go back to your teams and start to kick off the TechSprint. At this intersection of affordability and access, we have the opportunity to rewrite the system. Right? That is what the FHFA is asking us to do. They're saying, hey, we recognize there's inefficiencies, we recognize there's gaps, we recognize that there's opportunities for technology to change the game, and that's why all of you are here. Yes, so thank you very much for that. Secondarily, I just want to highlight that this is a really big, hairy, audacious problem. Right? Like, if you think about what you've heard about today, there's no one single point in this system that can solve this issue, right? It's going to take multiple points with multiple points of view. It really takes a team effort, and that's what we're trying to model here with the TechSprint this week. And lastly, I would remind you, in the words of John Hope Bryant, history doesn't feel historic when you're sitting in it. But this is it. This is it. So welcome to the FHFA inaugural TechSprint, and thank you all for coming today.
Right. Thank you, David, Michael, Pete, Melissa, Joanna. It's the data. It's the data. It's definitely at the heart of technology. It's at the heart of responsible innovation. It's definitely at the heart of this sprint. That was a truly inspirational session. So if you liked what you heard, we do have a lot more to come over the week, including a slate of informative virtual webinars that'll be going on while the sprinters are sprinting. Later this afternoon, we'll feature the FinTech founders' perspectives, using experience to drive change. Tomorrow, on Tuesday, we'll have a panel focused in on using data as a competitive advantage, focusing on lenders in the age of FinTech. And then on Wednesday, we're going to feature 2 virtual panels, one focused on surviving the mortgage tech winter. Where do we go from here? And then the last panel is going to focus in on building the pipes, which is going to feature the partnership between FinTechs and data aggregators. So I think those will be great sessions. They're still open for registration for virtual attendance if you're interested in listening in. And then finally, on Thursday, the TechSprint will culminate in Demo Day, where we'll feature another great lineup of speakers here in Constitution Center, including hearing again from Jason Cave, FHFA Deputy Director of the Division of Conservatorship Oversight and Readiness, and Head of FinTech Strategy for the agency. Joanne Barefoot will moderate a fireside chat style session featuring Lisa Rice, President and CEO of the National Fair Housing Alliance, as well as Delicia Hand, Director of Financial Fairness Advocacy at Consumer Reports. And our final panel will focus in on data and access in mortgage and housing finance, looking at the regulator's perspective. And of course, our main feature on Thursday, our 10 teams will have the opportunity to present and demonstrate their ideas to an experienced and diverse panel of judges. Now, before we set off to officially begin sprinting, I want to share with you a brief video that reflects on why FHFA has endeavored to host this sprint. This video reminds us that we've come together to solve for people. We're not just developing technology just for the sake of technology, but rather we want to make a positive impact on the consumer's experience in the mortgage finance process. Thank you, everyone, for joining us this morning. Thank you in advance to all the volunteers this week, and good luck to all of the sprint teams.